Good day, everyone. So today is our fifth week for the subject business finance. And now we are going to discuss our new topic. And this is all about instruction to investments. But before that, let me first introduce to you or read to you the objectives. So, objectives. At the end of this chapter, the students should be able to A. Define investment, B. Identify the types of investments, C. Determine the market price of bonds, and letter D. Compute the price of common stocks. So now, what are those concepts of investments? So, if you were given 10,000 pesos to invest in a Philippine company, which would you choose? So the term investment, as of this writing, does not have a universal working definition. So its meaning varies across different disciplines which are highly influenced by their own governing theories and principles. So regardless of the many definitions of the term, they all have a common ground, that is investment provides financial or economic returns to the business. So types of investments. So what are those types of investments? So investments are broadly classified into the following. So the first one is we have financial instrument. So when you say financial instrument, it is a contract that provides financial assets to one party and at the same time entails financial liability or equity to another. So investments classified as financial instruments include among the others, the following is the first one we have, the stocks or equity instruments. So what is stocks or equity instruments? And then we also have the bonds or debt instruments. And then with letter C, we also have the cash. So wherein cash includes the bills, the coins, and money deposited in the bank. So when you say cash equivalents, this include the short-term and the highly liquid investments that are readily convertible into cash. So examples of cash equivalents are the treasury bills of the BSP or the Bangko Sentral ng Pilipinas and time deposits or money market instruments. The fourth one is we have the trade account. So this represents the right to collect a sum of money in the near future. So they include accounts receivable and notes receivable arising from sales of goods or services. And then we also have the fifth one, the mutual funds. So mutual funds, this refers to money pooled together by people and kept and handled by a professional manager. And then insurance funds. So when you say insurance funds, this refers to money collected and pooled by insurance companies from the premiums paid by the insured or policyholders and used as protection or hedge against uncertain risks. And next is we also have the investments classified as non-financial instruments. So this includes the first one, we have the real properties. So when you say real properties, these are non-financial instruments that represent hard or fixed assets usually attached to the soil. It includes, among others, the following. We have the land, building, or machinery if installed as part of the building. The second one is we have the inventories. So inventories are products that are intended for sale but remain unsold at the end of the period. So no economic or no or financial benefits are gained unless inventories are sold and collection is made. The third one is we have the patents. So patents are intangible non-financial instruments granted by the government. And then we also have the last one, the gold bullion. So gold bullion is a precious commodity which carries a high market value, most especially when the market is volatile. So next type of investment is what we call the investment in bonds. So these bonds are explained from the perspective of the buyer of the bond or the so-called investor. So a bond is a or is an unconditional promise to pay. So a specified sum of money at a determinable future time, and its periodic interest is based on the agreement. So bonds can be classified as follows also. The same with the instruments. So term bonds. So when you say term bonds, these are bonds that have a single maturity date. So for example, sa January 1, 2018, the business is authorized to issue bonds amounting to 5 million pesos. So that will mature on December 31, 2018. So may 10 years pa siya. So in this case, all bonds have single maturity date, which is December 31, 2018. So that's for term bonds. Ibig sabihin, maturity date niya. Next is the serial bonds. So serial bonds are those that have series of maturity dates. So these bonds are payable on installments. Kung si term bonds is single lang, si serial is payable siya on installments. So for example, ang business or the business is authorized to issue on January 1, 2018 for 5 years sa 2 million pesos bonds with the following maturity dates. So first, mag-start siya of course by December 31, 2018. So yung 2 million pesos na bonds, kailangan mo siya i-divide into 5 years. So ibig sabihin, every December, end of December, magbabayad ka ng installment which is 400,000 pesos. So that is for the serial bonds. Just remember the word serial. So it's for installment payments. Next, callable bonds. So these are bonds that can be called in or redeemed by the issuing company prior to the date of maturity. So for instance, the maturity date of the bond is December 31, 2025. But the issuing company may redeem the bonds before this date. So oftentimes, the redemption price or callable price is higher than the face value of the bond. So for example, the face value of the bond is 1,000 pesos. But it may be redeemed at 1,100 pesos. So may interest siya na 100 pesos. Next, the fourth one is we have the convertible bonds. So these are those that offer the bondholder the right to convert or exchange the bonds prior to the maturity date with shares of stock. So for instance, yung 1,000 pesos face value bond, it may be converted into 10 shares. So common into 10 shares of common stock with a par value of 100 pesos. Next is we also have the nominal rate and the effective interest. So pag sinabing nominal rate, ito yung this refers to the interest rate that appears on the face of the bonds. So it is usually expressed on annual basis. So when the nominal rate is multiplied by the face value of the bond, the result represents the interest income on the investment. So the investor receives cash interest income based on the nominal rate of the bond as a percentage of the face value. So for example, we have there the average interest rate in the Philippines from 1985 to 2015 is 9 and 52%, reaching a very high rate of 56 and 60% in December 1990, and a very low rate of 3.50% in September 2012. So we have here an example, illustration 1. So on January 1, 2018, this is our problem. Jenny requires 1 million pesos bonds at 10% interest, payable semi-annually on June 30 and December 31. So the life of the bond is 5 years. So pag sinabing semi-annually, here we have this one here, the word semi-annually. Ibig sabihin, twice. So 6, sa loob ng isang taon, meron siyang 6 months or so 6 months to pay, or sa every 6 months rather, sa every 6 months siya magbabayad. So yun yung June 30 at saka December 31. So required, so you are going to determine the amount of cash inflow every interest payment date. So the answer there is the annual cash inflow in the form of interest from bonds for a period of the 5 years is 100,000 pesos. Paano? So, Jenny acquires 1 million bonds, right? So, 1 million bonds we are going to multiply it by the 10% interest for us to get the annual cash inflow, which is 100,000 pesos. Or, yung yung kalahati ni 500,000, 100,000 pesos kasi semi-annually tayo. So, that is divided by 2. So, that's 50,000 pesos, or we can just simply divide 10% into twice. So, that's 5%. So, 1 million pesos times the 5%. So, our semi-annual interest is 50,000 pesos. So thus every June 30 and December 31, starting this June 30, 2018, and 5 years thereafter, Jenny will receive 50,000 pesos cash as interest income from her bond investment. So however, the true semi-annual interest may or may not be equal to 50,000 pesos. The amount depends on whether the effective interest rate is equal or not to the nominal rate. So in conclusion, to evaluate the true earnings from investment in bonds, one does not have to rely solely on the amount of cash received every interest payment date. So the effective interest rate of the bonds must also be determined. The effective interest rate. So this is different from the nominal interest rate. So in effective interest rate, otherwise this is also known as the yield to maturity or market rate of interest. So this is the true or actual rate of interest rate that or interest that investors earn from investment in bonds. So three factors influence the effective interest rate of the bonds, namely, so the first factor is real rate of return. So this represents the interest charged by the investor to the other party for using the money without considering the eroding effect of the inflationary changes. Next is we have the inflation premium. So this is the amount of interest charged by the investor for the effect of inflation while the money is used by another party. So the average inflation rate in the Philippines from 2009 to 2014 is 3.8%. When the real rate of return is combined with the inflation premium, the result is the risk-free rate. And now we have also next the risk premium represents. So risk premium. So this represents the risk associated with the investment. So it is comprised of business risk and financial risk. The fourth one is we have the business risk. So this under the risk premium rather, so we also have the business risk. So when you say business risk, this is directly related to the inability of the business to maintain stability and growth in its earnings as a result of losing its competitive position in the market. And then we also have the financial risk. So financial risk is directly related to the liquidity problem of the business. So that is not being able to settle its obligations as they mature. So again, when you say business risk, this is related to the inability of the business, and financial risk is related to the liquidity problem. So we have here an example. So the average real rate of return is determined as 2.80%, and then the inflation premium of our expectation is determined at 3.40%. And the risk premium covering both business risk and financial risk is set at 3%. So we are going to compute the risk-free rate and effective rate of interest. So for us to get the risk-free rate, we are going to add our real rate of return, which is 2.80%, and our additional inflation premium, which is 3.40%. So our risk-free rate is 6.20%. So that is how we are going to solve for the risk-free rate. We're just going to simply add. And then next is we are going to solve for the effective rate of interest. So we are just go also the same way with the risk-free rate. We're just going to add. So we are going to add now. We have already our risk-free rate. So our risk-free rate is 6.20%. So we are going to add it to our risk premium, which is our business risk and financial risk. So a total of 3%. So our risk-free rate and risk premium, the result of that is the effective interest rate, which is 9.20%. Next is the valuation of bonds. So valuation, this refers to the value of the bonds at the time of investment. So in the amount that the investor is willing to pay the issuing company. So the value of the bonds at the time of investment may or may not be equal to their face value. So the value of the bonds is equal to the market price at the time of investment. So how is market price determined? So first one is the market price of the bond is equal to the sum of the following. So the first one is present value of cash flows of the principal on maturity date, and then present value of cash flows from the principal on maturity. No, it's the present value of future cash flows from interest. And then the basic procedure to compute the purchase price of the bonds or the market value is outlined in the following steps. So the first step is compute the present value of the cash flows on principal by applying the present value of single amount. So you're going to use the effective interest rate and not the nominal rate. And then step 2 is you're going to compute the present value of all cash flows from interest by applying the present value of annuity. So you're going to use the effective interest rate and not the nominal interest rate. And then the last step is you are just going to add the results of step 1 and step 2, so the sum is equal to the market price of the bonds at the time of investment. We have here an example. So example problem is that Yvonne acquires bonds with 3 million pesos face value dated January 1, 2018. So the bonds have a life of 3 years and earn an interest of 6% payable annually on December 31. So the bonds are acquired at a cost of 2 million pesos or 2,845,300 pesos, which will yield an 8% interest rate. So what are you going to do is you're going to compute the discount on bonds. So since the market price is lower than the face value, the discount is computed as follows. So we are going to solve or deduct the face value of the bonds, which is 3 million pesos, subtracted by the market price, which is 2,845,300. So our bond discount there is 154,700 pesos. So the discount of 154,700 pesos represents a gain for Yvonne. She invested 2,845,300 pesos but will receive 3 million pesos after 3 years. So notwithstanding the amount of annual interest of 180,000 pesos, so it can be observed that the effective interest rate is higher than the nominal rate of interest. So if the nominal um, rate of bond is higher than the effective interest rate, so the market price of the bond is higher than the face value. So the difference between the market price and the face value of the bond is called the bond premium. So bond premium is a loss to the investor since the amount of money to be received in the future, which is equal to the face value, is less than the amount of money invested. So next, we have another problem. So on January 1, 2018, Nicanor has acquired bonds with 3 million pesos face value for 3,210,500 pesos. So the bonds bear an interest of 8% payable semi-annually on June 30 and December 31. So the bonds is for 4 years. So the bonds will yield an effective interest rate of 6%. So you are going to compute the premium on bond. So since the purchase price of the bond amounting to 3,210,500 pesos is higher than its value of 3 million pesos, so there is a premium of 210,000 pesos at 210,500 pesos. So the premium of 210,500 pesos on bond investment represents a loss of Nicanor since he has invested 3,210,500 pesos but will receive only 3 million pesos at the time of maturity. Bali naging lugi si Nicanor sa kanyang ininvest na money. Next is the market price computation. Here is it on how to solve for the market price So in the two preceding illustrations, we have the purchase price or the value of the bonds, which is equal to its market value has been given. So however, by applying the present value of single amount and the present value of annuity, the market value of the bonds can also be determined. So the computation appears as follows. So on the problem that I have read a while ago, so the present value there is 3 million pesos. So deducted by 0.7938, that will be equal to 2,381,400 pesos. And then with the present value of 180,000 pesos annuity, so we have there a total of 463,878. So our market price of the bond is 2,845,278. So we're just going to add, for us to get, we are just going to add the present value of 3 million pesos and the present value of 180 pesos annuity for us to get the market price of the bond. So the market price or the purchase price of the bonds in illustration 1.3 is rounded off for simplification to 2,845,300 pesos. So the market price of bonds, just the same flow with the illustration 1.3. It's just the same with the illustration 1.4. So the market price or purchase price of the bonds in illustration 1.4 is rounded off to 3,210,500 pesos. Next, another problem. So on January 1, 2018, Angel has purchased bonds with 5 million pesos face value and with the following additional information. So we have there the date of bond issuance is on January 1, 2018. The date of bond maturity is on January 1, 2020. And then our nominal interest rate is 10% and our effective interest rate is 9%, and also our payment of interest is quarterly, meaning fourth or four times. So you're going to compute the purchase price or the market price of the bond. So the answer there is that the market price or the purchase price of the bonds is equal to the present value of cash inflows arising from interest payment and the payment of the principal. So the life of the bonds is 4 years. So since the interest payment is quarterly, so we are just going to multiply the 4 years into quarterly, which is also 4. So we get 16. So the periodic effective interest rate is 2.25%, wherein we are going to have use the effective interest rate, which is 9%, divided by 4, which is quarterly. So we get the periodic effective interest rate of 2.25%. So from this data, the market price of bonds is computed as follow, that we have shown you on the picture or on the slides, that the market price of the bond is now 5,166,575 pesos. So there is a bond premium of 166,575 pesos on the investment, since the effective interest rate is lower than the nominal interest rate. So this amount represents a loss for the investor. Next is investment in stocks. So buying shares of stock is another form of investment in financial instruments. So owning a share of stock makes the buyer an owner of a corporation. So the buyer is also called a stockholder or a shareholder. So a corporation is authorized to issue two types of shares of stock. So the first one is we have the common stock or the ordinary shares. So this is a stock whose holder has the same right or privilege like other common shareholders mentioned in the Corporation Code of the Philippines. So here are the rights of a shareholder identified by the Corporation Code of the Philippines. Include the following, among others. The first one is the right to vote, the right to amend the articles of incorporation, the right to adopt and amend bylaws, the right to be represented and vote by written proxy, the right to elect and remove directors and trustees, the right to subscribe to additional new shares or preemptive right, the right to receive dividends, the right to inspect bylaws, records of business transactions and minutes of the meetings, the right to the financial statements, the right to be issued shares of stock. So those are the 10 rights of a shareholder. So next, second one is we have the preferred or the preference share. So it is a share of stock that provides the holder some rights of privileges over the ordinary shareholders. So the preference shares are preferred as to the following. First, we have the dividends. So this dividends means that the dividends accruing to the preference shareholders should be fully met first before distributing any dividend to ordinary shareholders. So next is we have the net assets. So net assets mean that in the event of corporate liquidation, the preferred shareholders should be paid first of their investments based on the book value per share. Now, valuation of stocks. So when originally issued to incorporations, the value of the stock is based on her par value. So in other words, subscriptions of incorporators at the time of incorporation are issued shares of stock based on the par value. So when say par value, this refers to the nominal value of the shares of stocks appearing on the face of the stock certificate. So shares of stock that do not have par value are called no par value stock. So we have two stock valuation methods. So the first one is we have the discounted dividend model, and then the second one is the constant growth model. So for a discounted dividend model, we have here the valuation of stock is based on the present value of cash arising from the following elements. So the first is the cash dividend every year, and then the price of the stock when sold. So the formula to compute the stock price or the current market value of the stocks using the discounted dividend value or model is as follows. So S is equal to DPS over R minus G, wherein S is our stock price of the common stocks. Then DPS is the dividend per share. And then R is the required rate or discount rate on stock. And then G is the dividend growth rate. So we have here an example for you to understand more. So we have here a problem. Princess Corporation declares common stocks price at 5 pesos per share at 5%. So of its 100 pesos par value. So the common stocks of Princess are currently valued in the stock market at 158.75 pesos. So the stock dividend history reveals the Princess has a dividend growth rate of 5% and a discount rate of 8%. So we are going to use the discounted dividend value or model to compute the market price of the common stocks of Princess. So the market value of the common stocks is computed as that. So our DPS or our dividend per share is 5 pesos or 5%. So our required rate or discount rate on stock is 8%. And our dividend growth rate is 5%. So now, just simply solve that one so that we can get our stock price of the common stocks is equal to 166 and 166 pesos and 67 centavos. So since the common stocks of Princess are currently selling in the stock market at 158.75 pesos per share, the stocks are undervaluated. So using the discounted dividend model, an investor may consider buying the shares of Princess. However, in case the stocks of Princess are currently selling at 170 pesos per share, the stocks are overvalued and investors may consider buying the shares of Princess. However, in case the stocks of Princess are currently selling at 170 pesos per share, so the stocks are overvalued and investors may not opt to buy the shares. Next is the constant growth stock valuation model. So the constant growth stock model, on the other hand, appraises the stock on the assumption that future dividends of companies will grow at a constant rate. So the formula to compute the value of the stock using the constant growth stock appears as follows. So we have there the formula. Or we have there S is equal to D sub 1 minus R minus G, wherein the D sub 1 there is the um, next year dividend at a time. Here we have there S, stock price of the common stocks, and then D sub 0 is the current dividend, D sub 1 is the next year dividend at time 1, R is the required rate of return, and then G is the growth rate of dividend. We have the same here a problem. So our stock price of the common stocks is 120 pesos. So that could be all for our lesson for today. So again, so now we have the stock price of 126 pesos may be used by investors to determine if the selling price that Heisel quoted in the market is overvalued or undervalued. So that ends our lesson for today. So we are going to continue this one next meeting. So that could be all for today, and goodbye.